Hello everyone around the world. Welcome to our Fintech webinar. My name is Attila and I'm going to present to you the Fintech Toolkit, Smart Regulatory and Market Approaches to Fintech Innovation. In this recent publication, we analyzed the range of tools that are available to us in order to promote financial technology innovation in the market, and to do so in alignment with financial inclusion, stability, consumer protection, and integrity objectives. We particularly look at the sequencing of these tools over different stages against the background of the maturity of fintech in a market and the capacities within regulatory authorities. The tools we consider include tools such as innovation hubs, regulatory sandboxes, testing and piloting regimes, waivers or no action letters, restricted and special fintech licensees. When we talk about fintech here, we consider common definitions such as those from the Financial Stability Board. That is, fintech covers technology-enabled innovation in financial services that could result in new business models, applications, processes, or products with an associated material effect on the provision of financial services. Now, every paper transports an idea, and here's really our idea. It's about the regulatory architecture. Generally speaking, and in very simple terms, when we look at the markets in which we operate in, we can usually see a set of rules for non-bank financial institutions, and we can see a set of rules for banks with more prudential regulations, such as for capital requirements. Now, these rules create entry requirements, and the issue is really about the gap. Now comes fintech along. Fintech is reshaping the financial sector at an unprecedented pace. Fintech can stimulate competition and product variety and make financial services more inclusive to a wider set of people and businesses. But in order to capture these positive outcomes and benefits, we really need adequate approaches to enable that innovation. So we have been thinking about creating those safe pathways for innovators, for fintech firms. So how can we create lower entry barriers that are needed for these innovative fintech firms? And this is where the idea of proportionality comes in, right? Now, this idea is nothing new. The concept of proportionality can be found and seen, for example, in applications for KYC. So this publication, or the Fintech Toolkit, is really about creating an ecosystem that is required to support innovation balanced with financial inclusion, financial stability, market integrity, and consumer protection considerations. And this includes pro-innovation regulatory approaches as much as infrastructure in the market to support demand and supply, such as accelerators, tech clusters, or partnerships for matchmaking, collaborative innovation. Regulatory frameworks will determine the future of fintech. Based on global good practice, regulatory approaches in sequence stages can really help to create those pathways that are needed for innovative fintech firms. We call these the 7 stages of smart regulatory approaches. Now, what are these? Well, firstly, regulators can identify and modernize unsuitable regulation or abolish regulation altogether, so-called red tape. And this can be done based on a regulatory impact assessment. Regulatory impact assessments help to determine whether your legacy rules remain useful or not. Second, of course, proportionality, as mentioned, is key when creating those new formal and supportive pathways or regulations for fintech startups. Proportional regulation includes stricter rules for larger firms and more lenient rules for smaller ones. Proportional regulation is reflected in provisions for market stability and integrity, depending on the extent of the risk underlying the activity of the financial service provider. Now, proportional regulation can enable that create that supportive pathway that is really needed for new and particularly inclusive non-bank financial services. Third, an innovation hub. An innovation hub is basically set up with experts of the regulatory authority. Its purpose is or can be to informally guide fintech firms through the regulatory maze, to yield valuable insights into market developments, and to assess possibilities of further dispensation or exemption. Fourth, regulators can create leniency or room, as well as exemption from licensing requirements for testing and piloting purposes. Testing and piloting regimes allow to apply flexibility in a wait and see or test and learn approach to really help assist innovative firms to go along or go ahead with their products and services in the market. Authorities can also further decide to tolerate innovations by firms, either by licensed institutions or possibly even by startups, by extending so-called waivers or no action letters on a case-by-case basis. These waivers and no action letters declare a certain activity as permissible, or they suspend certain rules. Fifth, a regulatory sandbox. Much has been said about them in the past, so we will not go into detail here, but basically the idea is that a regulatory sandbox standardizes the scope of testing and piloting for innovative firms and allows a regulator to create a very narrowly defined safe space for granting exemption or dispensation from specific rules for particularly innovative firms over a particular period of time. Sixth, we're talking about restricted licensees. Restricted licensees allow feasible, innovative firms to further develop their client base and financial and operational resources in a controlled manner, using a restricted license. So there's two examples here I'd like to share. One is from Australia, the ASIC. So fintechs there, for example, in Australia, are required to obtain an Australian financial services license, right? In order to do so, they need to undergo a regular application process. However, the license can be tailored to a particular circumstance of the fintech applicant, and the applicant only needs to apply for relevant authorization of that particular activity. So if the fintech only offers two types of financial services, it only needs to apply for those particular services a license. It does not need to apply for a full license. This way, the application process for fintech firms are simplified. And some activities are even exempted from licensing requirements altogether. Another, and one of my favorite examples, comes from Singapore. There, the Monetary Authority of Singapore was planning to issue digital banking licenses. And when it did so, I find it particularly interesting how it did that by using proportionate or risk-based approach to licensing of those digital banks, meaning it really created criteria that helped to ensure a level playing field with existing banks in the market in order to avoid disruption. So what the MAS, the Monetary Authority of Singapore, did is it created a gradual increase in the requirements for digital banks that move through a two-stage process over 3 to 5 years, from a restricted digital bank to a full digital bank. So minimum paid in capital and total deposits, and as well as the permissible activities of digital bank increased gradually over time as the maturity of that digital bank, and particularly its maturity or capacity in risk management and in complying with regulations, enhanced over time. So with this, the MAS introduced a new regime carefully for digital banks in coexistence with existing banks. It really tried to avoid creating a disruption in the market, and primarily to create an added value for financial inclusion, to help new clients benefit from the digital banks that do not compete with the existing banks, but can benefit from technology and hence cost advantages. Seventh, let's look at the seventh stage of our smart regulatory approaches. We're talking about a full license. And a full license eventually is essential even for innovative firms as their size requires and their size and maturity permits. Now, over these 7 stages, as the regulatory rigor increases and the cost of regulation increases, so does the fintech firm's maturity and ability to cope with risks and with compliance. And this will help to maintain a level playing field for all licensed entities. There's a few special cases that we also look into. Those are the umbrella license, the voluntary fintech license, and the regional fintech license. You can find more of them in Fintech Toolkit. This toolkit seeks to support regulators and supervisors in rethinking their approach to the challenges presented by the latest wave of technology and finance. So this toolkit, as we have seen, presents novel regulatory as well as market approaches in support of safe fintech innovation. And as we've pointed out, regulatory frameworks really determine the future of fintech. And in this paper, following principles from global good practice, mainly proportionate regulation, sequenced regulatory approaches are presented that help create those pathways for the growth of innovative fintech firms. In this paper, we also look particularly at market approaches. So market approaches that strengthen demand and supply, because demand and supply often eventually propels innovative entrepreneurship and fintech growth. Market approaches to fintech combine such approaches as the support of financial and digital literacy in the population, or cybersecurity capacities in the sector, or acceleration programs and investor friendliness in the business and investment environment, as well as technology clusters in cooperation or public-private partnerships. This report, the Fintech Toolkit, was co-authored by the professors Dr. Dirk Zetsche from the University of Luxembourg, Douglas Harner from the University of Hong Kong, and Ross Buckley from the UNSW Sydney. And we'd like to really point out that this report provides policymakers and regulators with guidance and the range of available options at their disposal to harness fintech innovation derived from global good practice. And we'd like to also point out that the choice of any one particular approach is, of course, a matter of sovereign discretion, informed by the local expertise in the domestic market. In the Fintech Toolkit, we started by looking at the wider context of fintech. We look into the fundamental trends that are currently taking place in finance and that are shaping the digital transformation of financial systems. It is becoming clear that the type of players in finance are changing as so-called big techs, meaning big technology firms, as well as smaller startup fintechs, and lastly, technology firms all enter into the financial system. This points out that the financial sector is converging with the information and communication technology sector at an unprecedented pace. Now, this enables new opportunities in terms of business model and products and services by, for example, and most importantly, making financial products and services customizable and or customizing them down to the individual level. However, the convergence of technology and finance sectors also increases the rate of innovation and the volume of data at an unprecedented pace. Now, all of this has, of course, implications for policymaking, as the scope of financial policy objectives is really widening and shifting. And last but not least, we can see that the regulatory tools at the disposal of central banks and other authorities are modernizing and widening as well, and that these tools can really help to enable and to supervise fintech much more effectively. In the Fintech Toolkit, we dedicate significant space to the financial policy objectives. That is, we point out the potentials as well as the risks of fintech for financial inclusion, for stability, for financial integrity, and consumer protection. And we really point out the important role of ours to align the enablement of fintech on the one hand with those particular important requirements for inclusion, stability, integrity, and protection, a framework that is also known as the ISIP framework. So this really comes down to making sure that we capture the benefits of fintech while limiting the downside potential. As we move on in the Fintech Toolkit, we pay particular attention to specific design and implementation considerations. So before implementing any of the regulatory or market approaches, we look at the preconditions, that is, the collection of the important data in order to better understand demand and supply, and as well as potential gaps. We also look into the importance of a common definition for fintech and a common vision for fintech. Now, both will allow to really set the agenda and to specify the scope of the fintech spectrum that is relevant to the particular economy or country under consideration. And lastly, we look into the governance framework. That is, how can we best ensure the interinstitutional coordination between all of your involved stakeholders, from the policy to the market level, or on both the public and the private side. We really hope that these key conclusions stand out in the Fintech Toolkit. Fintech is reshaping finance at an unprecedented pace, and this has both positive and negative effects. Likely even more so in the high potential markets that we see in the Middle East and North Africa region. We started off by pointing out our main motivation to create safe, paved pathways for fintech innovators. And now, this requires an entire ecosystem that really is geared and tuned towards allowing innovation in the market balanced with financial inclusion, financial stability, market integrity, and consumer protection considerations. It is regulatory frameworks that will determine the future of fintech, and we've presented 7 stages of smart regulatory approaches that are at the disposal of the regulator and supervisor in order to best support and enable safe fintech innovation in the market. We can start off by modernizing legacy regulations and by implementing proportionate regulation. And so as regulatory rigor and costs increase, so tend to do our fintech firms' capacity to cope with those risks and with the compliance of those rules that we put in place. Now, it is eventually demand and supply side factors that will propel fintech growth. And in the paper, we've also presented and laid out market approaches that need to go hand in hand with regulatory approaches for that vibrant fintech ecosystem. Last and perhaps most importantly, we believe it is absolutely key in order to pay attention to regionally harmonized regulatory frameworks for fintech, because the more consistent regulatory approaches are across the entire region, the more attractive each and individual market will be to outside innovators. So, it is sequence reforms that are informed by global good practice, that are responsive to the local context, and that contribute to regionally consistent frameworks, that are policymakers, we believe, best options to support a vibrant ecosystem for fintech. Yes, it is effortful, but it is concerted efforts that will enable innovative financial service providers to tap the market, to reach scale, and to enable fintech for financial inclusion, for enhanced competition, and for long-term economic gains. I hope this was useful to you and you're interested in the Fintech Toolkit. I'd like to thank you for your attention, and I wish you and your loved ones to stay safe.